Are you a business owner that made $200,000 in net income? That is equivalent to $60,000 in taxes if you are in the 30% tax bracket. I am going to show you how to pay zero in taxes. Let's understand first three things: gross revenues, net income, taxable income. Gross revenues are going to be your total sales for the year. So assuming you have a small business that made $500,000, that would be your gross revenues. Now, you're going to take your operating expenses and now you're going to arrive to your net income. Now it's up to you whether you want to pay $60,000 in taxes at the 30% tax bracket, or we're going to apply strategies and bring that bill to zero. Let's start with Section 179, Special Allowance for Depreciation. I like this one when I think of a car. Let's assume it's 2025 and I need a car in my business, and I really am not sure whether I should buy one or not. Well, maybe this will make you change your mind. With Section 179, as long as we follow certain requirements, we are able to take the full write-off of a vehicle. Now, one, this vehicle must be at least 6,000 pounds. The purchase of the vehicle must be done in the year that you're taking the deduction. And obviously you have to have net income to be able to write it off of. Let's assume that I do need this car, and instead of me wanting to pay taxes, I follow those rules and I go and buy the vehicle for $60,000. That's gonna take a huge chunk and also make me very happy. Now, you could use this for other things, like if you have a printer shop or any kind of business that you really need something, and the most important thing is you don't have to pay it in full. You could pay it in future years. So not only you have received this tax savings, but you also now have equipment that you could pay over the course of time. Now what we're gonna do is we're going to deduct the $60,000 at 30%. You just saved $18,000 in taxes and you got your happy car. Now you have $140,000 left. Now we're going to continue breaking this down. The next thing we're going to do is we're going to use an HSA. Basically, an HSA, you go to the bank, you open a health savings account, you're gonna get a debit card, you're gonna use it for everything for medical purposes. If you don't get sick, don't worry. This money keeps growing tax-free and it moves on from year to year to year, making it very possible for you to save for that particular emergency you're hoping it never happens. So now let's take the $8,300 that you are allowed as a family, and then let's do it again, times 30%. What is that really saving you, assuming that you are in the 30% tax bracket? So now we take the $8,300 for an HSA. We think at 30%, now we're saving $2,490, and we have that special savings account for medical purposes. That leaves us with $131,000 that we need to continue lowering. So we're going to start from the top again, so we have enough room. Now, the next one we're going to talk about is, do you have kids? Depending on their age, obviously, if they're not gainfully employed and they are able to work or do something for your business. Can they pick up trash? Can they straighten out paperwork? Can they clean the desk? Can they answer emails? It all depends on the ages. Now, if they are not gainfully employed somewhere else, and we want to take a full deduction for them and their work that they're doing for us, and it is important, they're doing work for us, you got to pay them payroll. If you're self-employed, the kids will not be subject to Social Security and Medicare. If you have a corporation, they will be. So there will be some expenses there, some minor expenses, but it'll go through the retirement anyway. Now, we are going to get $15,000 deduction. Let's assume that you have 2 children. That is a $30,000 deduction for paying your children. So we're going to take $30,000. Now we are down to $101,700. And if you realize what's happening here, you are keeping all this money somewhere within you. $30,000 at 30% tax bracket, that would be a $9,000 savings in taxes. I'm using the 30% tax bracket for simplicity purposes. The next strategy is not very well known, widely used among people who really want to tax strategize. It is called the Augusta rule. Basically, what it is a rule that it allows you to use your home, rent your home to your business for a certain amount of money. Instead of going to to a hotel, you are going to rent your home up to 14 non-consecutive days, and you're going to get the fair market value for what it would be like instead of going to a hotel and renting their conference room. Depends on the market. You're going to educate yourself as to how this would work. Normally, for example, in the Central Florida market, we have a lot of competition, so one evening would probably cost $1,500 to $2,000. So assuming that you get 14 consecutive nights and you rent your home, and remember, this is non-taxable to the owner of the home. It is a special benefit, and it is called the Augusta Rule. So we take $28,000, $2,000 a month for the Augusta Rule for 14 days. At the 30% tax bracket, we would get an $8,400 tax savings just for using your own home for your own business. Now, we are down to $73,700 that we really want to wipe out. Okay, so starting over with the board here. We are at $73,700 from, remember, $200,000 in income. Now we want to zero this out. And I want to show you a couple ways that we could probably do this. One of them is utilizing the SEP IRA. The maximum contribution for a SEP IRA is $69,000. And that at the 30% tax bracket would be $20,700 in savings. Here's what I want you to think. If you were to put in an investment right now, money, do you make $20,700 immediately? Well, that is what's happening when you're taking this money and keeping it in your bank account. You get an immediate return because otherwise that money would be going to Uncle Sam. So it's better in your name, regardless of the chances that it takes in the market, because more than likely you will be fine long term. So now we go back and say we are down to $4,700 now in net income. Now this is going to go as a self-employed, this is going to go to your tax return. Then you, as married, you are going to take the standard deduction, and once you take the standard deduction, you are going to go actually negative, and you're basically down to zero. You cannot go, and this is the standard deduction. So we start at $73,700. Now, in order to keep chipping this down, I mean, there may be other strategies, but right now let's talk about retirement. It is advisable that you do save for your future, and this is probably the best way to do it, by lowering your taxable income. A SEP IRA would probably be the best in this case because it allows you as a self-employed individual to put this much money, $69,000, towards your retirement. Now we are down to $4,700 in taxable income. As a self-employed individual, this is going to go to your tax return when you do the standard deduction, which is going to be $30,000. For a married person, $12,000, you're still going to net zero income tax. I do want you to realize something. When you do a retirement plan, and I get a lot of complaints from people, I don't want to put all that money away. I get it and I understand it. However, I do want you to think of something. How often do you get an immediate rate of return? If you would have not done that, assuming at the 30% tax bracket, you're paying $20,700 in tax. What investment gives you an immediate rate of return? You keep that money, you put it for your future. So it is very important to think in these retirement plans. They're great tools. And if you're trying to invest, this is a great investment in yourself. Now let's talk about a different plan, a defined benefit plan. And this can be done if you're a corporation or if you are self-employed individual. With a defined benefit plan, the maximum amount that you could put for the year is $280,000. Just imagine, we would have been over with that one strategy. We could have wiped out our entire income. But I wanted to explain to you all these other strategies. So now we're down to $73,700. We create, again, a defined benefit plan for the corporation or the self-employed individual, and we are gonna put all of it. Now, this gives you zero taxable income. You don't depend on the standard deduction or anything like that. And let's remember, this $4,700, if you're self-employed, will be subject to self-employment tax. That's another tax that we are not able to cover. However, if you go with the defined benefit plan, you can bring it down to zero. That would be your taxable income now at zero. And we did it. I do want to emphasize, besides saving about $22,110 at the 30% tax bracket with a defined benefit plan, you are able to not have to put it all at once. You can actually set up a defined benefit plan, like literally and fund it up to the extension of the tax return. So you are able to fund it throughout a longer period of time if you do not have the funds because you did not plan accordingly, but you will be able to put all this money away within so many months, especially if you made $200,000 in income, because you would have paid a ton of money in taxes any other way. This is keeping it all in your pocket. If you have any questions, leave them in the comments. I'll be happy to answer back to you. If you like this video, please subscribe, and I will see you next time.